There's a lot of creativity that you can do with real estate because maybe you want to buy a property for yourself to live in and you also want to buy a rental property, but you just don't know how to juggle that. Well, according to the definition of a primary residence, when you go to get a mortgage, you're getting a primary residence mortgage. That primary residence can be a townhouse, a single family house, a condo. It can be a duplex, a triplex, or a 4-unit property, which means you could go out and buy this $1 million 4-unit property for you to live in yourself. Now, maybe you can't afford the costs on a $1 million property, but for this example, let's just assume that you're able to find a way to purchase this property. Maybe you can get a low down payment mortgage. Maybe you have the money for a bigger down payment. Let's just say you have the money for a $200,000 down payment here. You're still concerned about how you're going to keep up with the cost, but you had the $200,000 saved up, so now you go out and finance this property with an $800,000 loan. Sure, you could use a smaller down payment, but let's just stick with this example here. Now, you purchase this property, this 4 units, you are going to live right here for yourself. And now what you do is you're going to rent out the other 3 units to your neighbors, who are going to be your tenants. And they're all going to pay you $2,500 a month. So this unit is paying you $2,500 a month, this unit is paying you $2,500 a month, and this unit is paying you $2,500 a month, which means now you're making $7,500 a month in rental income, and you're living in this unit right here. Well, you still have expenses to pay because now you are the owner of the property, so let's go through this. You're making $7,500 a month from your 3 neighbors or tenants that are paying your bills for you. Now, out of the $7,500 a month, you have expenses to pay. You have to pay property taxes at about $1,500 a month. You have to pay property insurance around $400 a month. You have to pay for your maintenance costs. Let's call it $750 a month. You have to pay for your management. Well, now, because you are the manager of the property, you're the one that's collecting rent, I'm gonna say 0 because you're actually living in the property yourself, and I'll help you support your cash flow because you're buying this property to generate some cash flow, but also live there yourself too. And then you have to pay for the vacancy costs, or think about the vacancy costs, because you're gonna have some time where people are not there, and I'm gonna assume 10% of this gross rent, so $750 in vacancy cost. Add up the expenses and you have $3,400 a month in monthly expenses to operate this property. You're making $7,500 a month, which leaves you with $4,100 in net income, which sounds great, but don't forget, now you got a mortgage you got to pay for as well. You finance this $800,000 property, so let's take a look at that. You don't have to get an investor's mortgage. You're getting a primary residence mortgage because you're living here yourself. So let's say you're paying about 6.25% for a 30-year mortgage. It's going to cost you right around $5,000 a month, which means you are going to be losing $900 a month to purchase this property. But don't forget, you're also living here, which means this is effectively your rent cost or your mortgage cost. And this mortgage is now for this $1 million property that you purchase. Now, here's what's interesting. You are paying $900 a month to live here versus your neighbors are paying $2,500 a month to live there. So you're actually getting a little bit of a discount to live in this property because now you own the property, and then it gets a little bit more exciting because now a year goes by. After a year, you legally have the ability to leave this property and rent it out to somebody else. That's what the primary residence mortgage says. So now a year and a day go by, you go out and you purchase a different property, and now you rent this out for $2,500 a month. Hopefully it's in a good area and it can rent for a little bit more, but let's just assume you rent it out for $2,500 a month. Now this $2,500 a month is going to cover this loss that you had, plus put some money into your pocket every single month. And now you are making a profit on this property that you purchased to live in yourself, and now you're making a positive cash flow, and now you have another place to live because you can do this year after year after year, assuming that you live in a property for at least a year and a day. Now, it doesn't have to be a 4-unit property. It could be a 3-unit property, a 2-unit property, or even a single family house that you buy, live in for a year and a day, move out and rent it out to somebody else. And every time you do that, you get to qualify for the lower mortgage, which is the personal primary residence mortgage, as opposed to getting an investor's mortgage. So if you're interested in investing in real estate, but you also want to buy a house to live in, this could be a creative way for you to get started. And if you don't want to do a 4-unit property, again, you can start with a single family house, live there for a year and a day, move out and let somebody else live there, and keep that mortgage in place. And now that tenant can pay for the expenses. And if you do the math right, put some money in your pocket year after year after year. This is a way to get started in real estate called real estate hacking, where, well, it's a creative way to get started. And finally, last but not least, is number 4, cash investments for cash flow. Now, I kept these last because this really isn't an investment. It's a way to generate some interest on this cash then your cash really just isn't sitting idle. Right now, at the time I'm recording this video, the average interest rate on a bank account in the United States is about 0.4%, which is essentially nothing, especially when you compare that to inflation. So if you put this money into a normal savings account, you're going to be losing value, but then some people like to take this cash and put it into a CD, a certificate of deposit, which is going to pay you more than a savings account. At the time I'm recording this video, the average 5-year CD in the United States is paying around 1.3%, which means yes, if you put your money into a CD, you're still going to be losing value to inflation. And then you can consider putting some of this cash into a high-yield savings account. A high-yield savings account is a savings account. They should be FDIC insured. If it's not, don't save your money there. But a lot of these high-yield savings accounts are reputable banks that don't have the same overhead of a physical bank. So instead of driving into the bank branch, it's all digital. But it's still FDIC insured, and it's still a normal bank. You just have to do it all digitally. And at the time of me recording this video, high-yield savings accounts are paying roughly around 4% a year in interest, where now we have some decent interest because the average inflation rate is right around 3%. And if you're generating 4% a year in interest from this high-yield savings account, well, now at least you're not losing as much value as if you were just keeping the money in a savings account. Now, still, in a high-yield savings account, you're not really making much money because inflation is eating away at the value of your savings, and a lot of times the real inflation that you're feeling is higher than the reported inflation numbers, but it's better to get something instead of nothing. And a high-yield savings account definitely beats having a traditional savings account, assuming that it's an actual reputable bank instead of a bank that, well, is not FDIC insured, and now you're essentially putting your money into a scam Ponzi scheme. So definitely do not do that. But if you have some extra cash and you don't want to invest your money, at least generating some interest, whether it's a savings account or maybe even a treasury, that way you can get some interest, is better than not getting any interest. So what is passive income? Real passive income is putting your money into an asset that you don't have to actively operate. And that could mean invest your money into stocks, but that takes more work and more potential risk for more potential return. The alternative to that is to invest your money into something like an ETF, where you can invest your money into a fund that specializes in dividends, or you can get more involved with something like real estate. Now, real estate has the biggest capital requirement, the most money you need to get started, the most time in the beginning. But once you build a good team, now it can be passive because now your managers are going to do all the day-to-day operations, and now you're just overseeing the managers that we don't have to do the day-to-day work. And it also has some of the best tax breaks, but it is the most difficult to get started. And then if you just have some extra cash, you can look for some extra cash investments while you're waiting for a better place to invest your money. Here, a savings account is going to pay you very little, a CD is going to pay you very little, but a high-yield savings account is going to pay you more, and some treasuries can also pay you more as well. Now again, if you are an investor and you want some more resources, you can check out the investing masterclass that I have for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor. That way we can help spread the financial education. Thank you. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.